if you try to weigh a freight train using a bathroom scale, you aren't just going to get the wrong number. You're going to completely break the scale.
Right, yeah, you'll just shatter it.
Exactly. You look down, you see an error message, and you probably think the scale is broken. But, I mean, the scale isn't broken. You are just using the wrong tool for the job.
Yeah.
And right now, Wall Street might be doing exactly that. They're using a bathroom scale to weigh, frankly, the most talked about company on Earth. So, welcome to today's deep dive.
Glad to be here for this one.
Yeah, for the value investors and tech enthusiasts listening right now, we are looking at a scenario where the broader market might be fundamentally mispricing NVIDIA. And not because the math is wrong, but because the market is just applying the completely wrong equation.
It is a fascinating premise, honestly. We're looking at a fundamental misunderstanding of what this company actually does now.
Right.
Like, everyone thinks they are pricing a fast-growing tech stock.
Right.
But the underlying reality of the business is mutating into something, entirely different.
And to figure out exactly what it is mutating into, we are pulling from a really compelling analytical piece. It's titled The Sovereign Moat, Revaluing NVIDIA as Industrial Infrastructure.
Great piece.
Yeah, it really is. Now, this analysis centers around a recent blog post by NVIDIA's CEO, Jensen Huang. And honestly, CEOs write blog posts all the time.
They do, yeah. Usually PR fluff.
Right. But the author of this analysis argues that Jensen is hiding a massive structural shift right in plain sight.
Yeah, so the mission for our deep dive today is to really unpack that shift. We need to understand why NVIDIA's competitive moat, that barrier that protects its business from rivals.
Right.
It's actually moving away from silicon chips and straight into the realm of physical energy. Grasping how this shift changes the very nature of what the company sells is like the ultimate shortcut to seeing the future of tech valuation before Wall Street fully catches on.
Okay, let's unpack this. Because to understand how a massive tech behemoth gets mispriced, we first have to look at how the CEO is redefining the industry itself.
Yeah, and he did it with a cake analogy, right?
Yeah, he did. Jensen Huang recently described artificial intelligence as a 5-layer cake. And he laid out these layers in a very specific order. At the top, you have applications.
Sure.
Below that, models. Then infrastructure. Then chips. And finally, sitting at the absolute bottom, forming the foundational layer of this entire cake energy.
What's fascinating here is how the market reacted to that versus what it actually implies.
How so?
Well, most people read that list, thought it was just, a colorful metaphor and moved on. But putting energy at the absolute foundation is a massive flashing signal to anyone paying attention to how economic moats are actually built.
I mean, I have to push back on this right out of the gate. We are talking about software and chips here. Usually we think of software as just code.
Sure.
It lives in the cloud, it feels invisible, it feels weightless. So why is the CEO of a chip company suddenly obsessing over the energy layer? Because NVIDIA designs processors, right? They don't run power plants. That feels like saying a company that makes car engines is suddenly an oil company. They just design the chip, ship it in a box, and, collect the check, let the data center figure out the electricity.
I get that. It is a completely natural reaction to look at it that way. But the distinction here is really crucial to understanding the new AI economy. Think about what generating an AI output actually requires. We need to clearly separate training an AI from actually using it.
Okay, break that down.
So training the AI is like sending it to college. It takes months, it uses massive amounts of power all at once, but it's a discrete event. The real shift, though, is in what we call inference.
Okay, define inference for us in this context, just so we're all on the same page.
Right. Inference is when the AI is actually taking the test. It is the moment you type a prompt into a large language model, and it generates a word, a line of code, or like an image. Every single token, every tiny piece of generated data is the direct result of a physical energy conversion. Every second of real-time inference consumes massive, tangible physical resources. It's not just some algorithm running quietly in the background on your laptop anymore.
So wait, every time I ask a chatbot to write an email, I am effectively firing up a small industrial furnace somewhere in a data center.
Precisely.
Yeah.
Jensen is redefining AI from a software execution industry into a heavy manufacturing industry. And when you manufacture something at a global scale, the primary constraint is always power.
Wow.
NVIDIA's chips are becoming so incredibly powerful and power-hungry that the company can no longer just ship a chip in a box.
Because what happens if they do?
If they do that, the chip will literally melt, or it will trip the power grid of the building it's sitting in. Yeah, so NVIDIA is effectively forced to design the entire data center architecture, the cooling systems, the networking, the power distribution, just to ensure that chips can actually operate. They aren't drilling for oil, to use your engine analogy, but they are building the only engines that matter. And those engines require a complete ground-up redesign of the global gas station infrastructure.
Okay, that completely flips the script. Because if you view AI as resource-heavy physical manufacturing, then the scale of the customer base has to evolve.
It has to, yeah.
If AI requires that much physical energy and cooling, you immediately run into a real estate and infrastructure problem. A couple of tech startups in a garage cannot secure gigawatts of dedicated power.
No, not at all.
They don't own land, they don't own power grids. So who actually has the capital and the physical resources to buy these massive systems now?
And that leads us to the most significant shift in the whole analysis. We are seeing a rapid evolution in who actually has the capacity to be an NVIDIA customer.
Right, because historically, the primary buyers for these massive computing clusters are the hyperscalers, the absolute heavyweights of the tech world, Google, Microsoft, Amazon, Meta.
Yes.
But Jensen's focus is shifting. He's not just negotiating with tech corporations anymore. He's negotiating directly with sovereign nations.
Yeah. The shift from hyperscaler to sovereign wealth is just a monumental leap in the business model. We are talking about countries like Saudi Arabia, Japan, and Canada actively building their own sovereign AI capabilities.
Look at what Canada just did. Their recent federal budget explicitly allocated billions of dollars specifically for AI infrastructure.
Exactly.
They are treating it exactly like national defense spending or highway construction. They're building national compute grids.
Which means taxpayer money is essentially being used to reinforce a corporate moat. Think about that. When a government commits billions from a federal budget to build physical AI assets sitting directly in that energy and infrastructure layer, they are making a generational commitment.
I want to dig into this idea of lock-in because it makes so much sense when you frame it around infrastructure. Like, if I use a specific brand of smartphone, I'm somewhat locked in because my photos, my apps, and my habits are tied to it.
Sure.
It would be highly annoying to switch to a competitor, but, I could do it in an afternoon if I really wanted to. But for the tech giants using NVIDIA, their lock-in has historically been software-based, right? Specifically, NVIDIA's CUDA platform.
Yes, CUDA is the vital piece of the puzzle here. It's the proprietary programming platform that developers use to write software for NVIDIA chips.
But wait, why does that create such a deep lock-in? If a competitor makes a chip that is, say, 10% faster or 20% cheaper, why wouldn't a company just buy the cheaper chip and run their software on that?
Because the code simply will not run.
Oh.
Yeah, imagine spending 10 years writing millions of lines of complex instructions in French. Then someone comes along, hands you a slightly cheaper Spanish dictionary, and says, hey, just switch to this.
You can't just switch.
You cannot. You would have to pause your entire business and translate millions of lines of code from scratch, retraining all your engineers in the process. The switching cost of rewriting all that CUDA-based software for a competitor's chip is astronomically high. That is the commercial software lock-in.
Okay, so that is how you lock in a tech company. But scale that up. Imagine scaling that up to the level of a nation state.
If we connect this to Warren Buffett's rule about switching costs, that the best businesses are the ones where the cost of leaving is exponentially higher than the cost of staying.
Right.
Sovereign-level infrastructure is the ultimate manifestation of that rule. When a sovereign nation builds its national AI power grid, its secure defense networks, its public health modeling, all meticulously coded on NVIDIA's proprietary CUDA architecture.
Running on physical data centers designed specifically for NVIDIA hardware.
Exactly. The cost of switching is no longer just a commercial headache. It becomes a massive political issue.
The moat evolves from a software lock-in to a geopolitical lock-in. I mean, if you are a politician, you can't exactly stand at a podium and tell your citizens that you are going to rip out billions of dollars of national infrastructure, abandon a decade of taxpayer investment, just to try out a competitor's chip to save a few bucks.
No, you'd be voted out immediately. The switching costs become practically insurmountable at the sovereign level. You are dealing with much larger contracts, planning cycles that span decades instead of fiscal quarters, and frankly, near zero default risk because your client is a government that can literally print its own currency.
Okay, so if I'm looking at my portfolio right now, I'm probably treating this like a massive booming software stock. A stock that could crash the moment the tech cycle cools down or the hype fades.
So that's how a lot of people see it.
But if the customer base is shifting to sovereign nations and the product they're buying is effectively national industrial infrastructure, well, that completely breaks the traditional way investors evaluate this stock.
It shatters the lens completely. If you look at NVIDIA strictly through a traditional tech company framework, specifically the price to earnings, or PE, multiple field, the company looks incredibly expensive.
Let's break that down because we hear PE multiple thrown around a lot. Why does a tech PE make NVIDIA look like a bubble?
A pure technology valuation framework assumes a few things. It assumes that software has high margins but low barriers to entry. It assumes consumer product cycles are cyclical. A tech PE prices in the constant risks that a couple of kids in a dorm room could invent a better algorithm and steal your market share overnight.
Right.
So when Wall Street sees massive earnings growth in a tech company, they often assume it is a temporary cyclical peak. They assume the margins will eventually collapse under competition.
But if we shouldn't be looking at it like a software company, what is the alternative?
We should be applying an infrastructure company framework. This is the exact same logic that Wall Street used to price railroad companies, telecommunications networks, and power grids a century ago.
Ah, this is where the classic value investing concept of Mr. Market comes into play. Benjamin Graham's famous allegory.
Yes.
Mr. Market is this emotional, manic, depressive partner who offers to buy or sell your shares every single day. Sometimes Mr. Market gets deeply confused. He uses the completely wrong framework to price an asset. We are arguing here that Mr. Market is currently viewing NVIDIA as a tech stock vulnerable to a cyclical downturn, rather than viewing it as a utility company building the digital railroads of the 21st century.
And once a utility is built, the economics are entirely different. Think about how a utility like cash flow actually differs from a standard software subscription model.
Okay.
A software subscription, even a very sticky one, is still vulnerable to disruption by better code. But a utility, a power grid or a railroad, the barrier to entry isn't code, it's physical reality.
Right, you can't just code a new transcontinental railroad into existence. You have to acquire the land rights. You have to lay thousands of miles of steel. You have to navigate zoning laws, environmental regulations, and massive physical supply chains.
Exactly. The cash flows from infrastructure are incredibly stable over long periods because the physical barriers to competition are just so high. The argument here is that Jensen's blog post is a deliberate attempt to force capital markets to adopt this new industrial infrastructure framework.
Interesting.
Yeah, if the market eventually realizes its mistake and reprices the company as a global utility rather than a cyclical tech stock, that is where excess returns are generated for the patient investor.
But wait, utilities are typically regulated, slow-growth, boring dividend stocks. NVIDIA is growing revenues at a staggering pace. How can you call them a utility?
Because we are in the build-out phase of the utility. We aren't looking at a mature water company in 2026. We are looking at the railroad barons of the 1880s.
Oh, I see.
The explosive growth happens while the tracks are being laid. The durable, wide moat utility cash flows come after the network is established, and everyone is forced to pay the toll to use it.
Okay, so they aren't just selling the pickaxes for the gold rush. They are paving the only roads to the mountain, owning the toll booths, and signing treaties with the governments who own the mountain.
That's one way to put it.
But, and there is always a but when the bull case sounds this invincible, building the world's most critical infrastructure doesn't just hand you a golden ticket. History shows us that owning the foundation of an entire economy puts a massive, glowing target on your back.
That is the crucial counterweight to this entire thesis. You can't have a deep dive into value investing without rigorously examining the bear case. And the analysis highlights two major uncertainties that could completely derail this infrastructure supercycle.
Okay, the first one is pure political risk. We just talked about how incredibly lucrative it is to have sovereign nations as your clients. But governments change.
Yep.
Administrations flip. The billions of dollars committed by Canada, Saudi Arabia, or Japan right now are entirely based on the priorities of the current political climate.
And political priorities are notoriously fickle. A new administration could come into power next year, look at the budget, and decide that domestic health care, housing, or debt reduction is a much higher priority than building a national AI compute grid.
Right.
Suddenly, those massive generational contracts evaporate or get stalled in legislative gridlock.
Here's where it gets really interesting. The irony is incredible. The exact same thing that is making NVIDIA so unbelievably powerful, these massive nation-state infrastructure contracts, is exactly what introduces a risk that Wall Street cannot model.
Yeah.
You can model supply chain efficiencies, you can model semiconductor yields, but you cannot mathematically model the outcome of a sudden election or a shift in geopolitical alliances with absolute certainty. They are tethering their future growth to global political stability.
If we connect this to the bigger picture, policy risk is the absolute hardest type of risk to price into a stock. And that ties directly into the second major uncertainty, which is antitrust risk.
Oh, yeah.
Historically speaking, any company that tries to own what we call the full stack, meaning they control the product from the absolute bottom energy layer to the silicon, the networking, and the software layer on top, they face intense regulatory wrath.
The comparison to Microsoft in the 1990s is impossible to ignore here. Microsoft dominated the operating system, but when they tried to leverage that underlying infrastructure dominance to also control the internet browser market, the government stepped in.
They did.
They dragged them to court and nearly broke the company apart. And we are seeing similar massive antitrust cases against Google today regarding their search and advertising dominance.
Regulators are highly allergic to monopolies that control essential economic infrastructure. If NVIDIA genuinely achieves this vision, if they dictate the architecture of the physical energy layer, manufacture the chips, build the data centers, and control the CUDA software models on top of it, regulators across the globe are simply not going to look the other way.
Because at that point, you aren't just regulating a tech company that makes consumer gadgets. You are regulating the fundamental engine of the future global economy.
Exactly. This is why value investors must always demand what Benjamin Graham called a margin of safety. Even when the logic of the bull case, this shift from software to an infrastructure framework, is incredibly clean and compelling, you have to protect your downside against unquantifiable risks.
Right.
You cannot assume a straight, uninterrupted line to global dominance when regulators, politicians, and the Justice Department are holding the pen.
So to bring this all together for you listening, we have covered some serious ground today. We started by taking artificial intelligence out of the invisible cloud and slamming it firmly into the physical world. We moved from viewing AI purely as software execution to seeing it as a massive physical manufacturing process constrained by megawatts of energy.
We examined how that physical constraint is forcing the customer base to evolve from tech giants to sovereign nations. And we saw how that evolution transforms NVIDIA's competitive moat from a commercial software lock-in to a deeply entrenched geopolitical lock-in.
And most importantly, we realized that if we are trying to value this beast accurately, we might need to put away our tech bubble calculators and dust off the frameworks used to value the great railroad and utility monopolies of the past century.
This raises an important question for you to consider. Look at your own portfolios or your own research notes. Ask yourself, which framework are you currently applying to the AI boom? Are you weighing the freight train with a bathroom scale, expecting a typical tech cycle correction? Or are you looking at the chaotic birth of a new global utility?
It really makes you rethink every headline you see about chip demand. I want to leave you with one final lingering thought that builds on everything we've discussed today. We talked about the financial risk of sovereign contracts and the threat of antitrust breakups. But if AI infrastructure truly becomes the new national defense grid, what happens when geopolitical tensions boil over?
It's a sobering thought.
If every major nation on Earth is locking their critical infrastructure, their military logistics, their public health grids, their economic modeling into a single proprietary ecosystem owned by one company, does that infrastructure eventually stop being a commercial product and start becoming a weapon of foreign policy?
No. Yeah.
I mean, if two sovereign nations go to conflict, what happens to the global infrastructure standard they both rely on? It shifts the conversation entirely from antitrust risk to national security risk. Building a longer front line from chips all the way down to energy might just mean there is a much higher risk of the company eventually being broken apart by regulators, or worse, targeted in a conflict.
It forces us to ask if the ultimate risk isn't just a market correction, but the weaponization of the very utility they are building.
Thank you for joining us on this deep dive. Keep turning these ideas over in your own mind, challenge your own valuation frameworks, and see what you uncover. As always, a quick reminder that everything we discussed today reflects our own personal analysis based on the provided source material. It is not financial advice, and you should always do your own research.
And the next time you try to weigh a massive opportunity, make sure you aren't about to break the scale.
Catch you next time.